What's up, everybody? This is Sunko, the Korean bro. Today is 2022, November 22nd. And let's look at economic calendar first, okay? But I guess, in fact, we don't have to look at it because we have a lot of events on Wednesday, but today is Tuesday, so we don't have that many events yet. So we'll look at it tomorrow because tomorrow we got a lot of events coming. Initial jobless claims, FOMC meeting minutes, crude oil inventories. We have that many events tomorrow. So we'll be looking at it tomorrow. Instead, what we're going to look at is mollyfool.com first, okay? This crypto enters unlike any other. Here's why that's a good thing, okay? If big oil gets into Bitcoin mining, is it time to buy Bitcoin? The Dow Jones is on track to the unthinkable. Where will Nvidia stock be in 1 year? Okay, first, let's read this one. This crypto winter is unlike any other. Here's why that's a good thing. Since their creation, cryptocurrencies have gone through several bear markets. Unlike years past, the current crypto market has to deal with the added pressure of a possible recession. Those with long investing horizons can use this current crypto winter as an opportunity to capitalize on historically low prices. Crypto goes through a cycles of boom and bust, but this one might be entirely different. This cryptocurrency asset class is no stranger to bear markets. Although the burgeoning investment category has had its fair share of corrections in its short history, the crypto winter currently gripping the market is unlike any other. Cryptocurrency got its start when Bitcoin was created in 2009. Since then, the market has evolved from just one cryptocurrency to a smorgasbord of tokens, stablecoins, smart contract platforms, and much more. From their humble beginnings, cryptocurrencies have often shed more than 2/3 of their value during each downturn. What the past tells us. In 2014, the asset class went through one of its first corrections. Its collective market cap reached a new high just shy of $16 billion in December 2013. Okay. It took until May 2015 to bottom out when it plummeted to as low as at $3.2 billion, a brutal descent that erased 80% of the market's recent peak value. So unlike so we have crypto winter these days. Its value went up really high in the past, and it went all the way down again. So those of you who invested a lot of money into Bitcoins will go through a tough time because it's gone down like 90% from all-time high. So, but here it says it's a good thing because you can get to have an opportunity, I guess. Let's get to the bottom and see why the author thinks that way, okay? Forming a game plan. On average, it takes the crypto market about 3 years before it's able to reclimb its previous high. So it says now it's gone down to really bottom, but it will take about another 3 years to get to its previous high. So I'll have to wait 3 years. But now the economy is in a bear market and the possibility of a recession is growing. The average recession lasts around 11 months. So normally a recession lasts about 11 months. Okay. And it's been only a year since crypto hit a new all-time high. If this winter follows a similar path to past ones and we take into account the potential for a simultaneous recession, it will be safe to assume that it might take another 2 to 3 years before any particular cryptocurrency recovers all of its losses. So here it says it will take another 2 or 3 years to get to where it was. Okay, although this won't leave investors with much confidence for the foreseeable future, there is a silver lining. Despite having a relatively short history compared to the stock market, crypto has shown that it is capable of recouping the losses it goes through. Looking at the past, investors who continued to build up their portfolios, regardless of prices, ended up reaping the greatest returns. Mm. Regardless of prices, those who continued to build up their portfolios ended up reaping the greatest returns. So those who got ready for its return ended up reaping a lot of profit. So I know that recession will last for 1 year, and this time it's more harsh than before because of COVID and supply chain and economic downturn, all of that mixed. It's pretty more harsh, but then it will take about 2 or 3 years. So if I just get ready with that uh, after about 2 years later or a year later, I can have that good opportunity in the future. I think that's the summary of this article. If it takes 2 or 3 years before prices rise again, investors have a long-lasting opportunity to buy crypto at historically low prices. So it's now low prices. So good buy point. Should the day come that crypto is able to gain momentum, those who remain steadfast in their allocation will then be positioned to benefit the most. Most importantly, remember to keep a long time horizon. Investing is a marathon, not a sprint. Remember to keep a long time horizon. Investing is a marathon, not a sprint. Okay. If big oil gets into Bitcoin mining, it's time to buy Bitcoin. Bitcoin mining companies are under tremendous pressure to green their operations. Shell will introduce a new technology that will enable Bitcoin miners to reduce costs and greenhouse gas emissions by 48%. So their technology will help gold miners to reduce operational cost. So which means it's gonna help Bitcoin, the value of Bitcoin go up. The new technology could boost the short-term prospects of Bitcoin, but the long-term implications of big oil embracing crypto are less certain. So short-term, it will help its price level go up, but in the long term, we don't know for sure at this point. Big Oil thinks it has a solution for the future of sustainable Bitcoin mining. Do Bitcoin investors agree? Bitcoin mining stocks have been coming under greater and greater pressure to reduce their electricity consumption and shift into greener sources of energy. As a result, many of them have been embracing solar, wind, and hydro solutions to power their massive mining operations. But now comes a new wrinkle in the push toward greener, more sustainable Bitcoin mining. The entry of Big Oil. Shell says it has an innovative new technology that can reduce costs and emissions for Bitcoin miners by as much as 48%. So, what can we expect for the future of Bitcoin if Big Oil decides to move aggressively into mining? Hmm. The greening of Bitcoin mining, the bullish case for Bitcoin, the bearish case for Bitcoin. Okay. Obviously, the entry of big oil into mining could have a huge impact on the Bitcoin ecosystem. New green energy initiatives coming from big oil could be a lifeline for troubled mining companies that have been reporting underwhelming numbers recently. So, its green move will help mining companies to have a better profit. Moreover, these initiatives could help to diffuse any governmental push for greater regulatory oversight over Bitcoin. So Bitcoin has been having a lot of pressure because of emission, uh, because of its consumption of electricity and like energy and stuff. But then this new technology can possibly reduce consumption of energy, so it's much greener, right? More environmental friendly. Moreover, these initiatives could help reduce any governmental push for greater regulatory oversight over Bitcoin. They could help to deflect some of the negative rhetoric coming from environmental groups. That's all very bullish for Bitcoin. I'm just worried about the perceived optics of crypto linking up with big oil. Instead of bringing more investors into the crypto space, it might drive them away, especially younger investors who have prioritized climate change and the environment. So keep your eyes on the space and realize that the entry of big oil into crypto comes with a mix of pros and cons. Hmm. Entry of big oil into crypto. Entry of big oil into crypto would possibly bring pros and cons. Okay, pros and cons. Entry of big oil into crypto world. Okay. The Dow Jones is on track to do the unthinkable. The Dow is on track to outperform the Nasdaq Composite by the widest margin since 2000. 2022 has been an amazing year for blue chip dividend stocks, but that doesn't mean you should sell your growth stocks. Hmm. Okay, let's skip and let's read next article. Okay. Nasdaq bear market, three remarkable growth, stocks down over 90%. They can double your money by 2025. The tech-centric Nasdaq composite has way down the broader market in 2022. Okay, this is an interesting article. Novavax offshore earnings. Let's start with Teladoc Health. The first phenomenal growth stock that has the tools and intangible necessary to generate triple-digit returns for investors over the next 3 years is a telemedicine giant Teladoc Health. Since peaking in February 2021, Teladoc shares have plunged by 91%. Let's look at price of Teladoc Health first, okay? Okay. Okay. Since peaking in February, Teladoc shares have plunged by 91%. Though valuation has certainly played a role, Teladoc has primarily been pummeled after grossly overpaying for applied health signals company Revongo Health. Grossly overpaying. Okay. The $18.5 billion deal has largely been written down, which is why Teladoc's year-to-date net loss is so unsightly. Okay. But there does appear to be light at the end of the tunnel for what's been a nightmare for shareholders. The bulk of one-time expenses tied to the Revongo deal have been written down, which should clear a path to a much cleaner income statement from Teladoc moving forward. More importantly, Teladoc has macro and company-specific factors working in its favor. In terms of the former, we don't get to control when we get sick or what ailments we might develop. There will always be demand for virtual visit services. Yes, that's right. There will always be demand. That's a strong point. It's easy to understand. Well, it's not me, but like people who lives in countryside will want to get help from a doctor who's not just good, who's really phenomenal. So if this service is out there, um, easy to use, then the competition among doctors will be fierce. Mm, that's for sure. Anyway, let's keep on reading it. In terms of the former, we don't get to control when we get sick or what ailments we might develop. There will always be demand for virtual visit services, no matter how well or poorly the U.S. economy or stock market is performing. Hmm. On a company-specific basis, Teladoc Health is completely changing how care is administered. Skeptics might refer to telemedicine as a fad that was aided by the COVID-19 pandemic. However, Teladoc was growing sales by an average of 74% per year in the 6 years leading up to the pandemic. Hmm. Teladoc is helping the entire treatment chain by making physician access more convenient for patients, as well as allowing physicians to keep closer tabs on chronically ill patients. The end result should be improved patient outcomes, which means less out-of-pocket cost for insurance company. So it's all for good. Doctor can help patients cure a lot faster, and doctor can help patients um, more often, and this will reduce the burden for insurance company because uh, less patients will uh, have illness, the less patients will die, which means the less money will be spent for insurance. Uh, so everybody's good. Doctor can have more work, more patients will be healed, and insurance company will spend less money, right? With losses expected to narrow in 2023, don't be surprised if Teladoc Health bounces back in a big way and ultimately doubles by 2025. Okay. Its price level is Teladoc Health. And next one is Upstart Holdings, a third remarkable growth stock that's been taken to the woodshed during the Nasdaq bear market, but has the potential to double your money by 2025. Is cloud-based lending platform Upstart Holdings. Upstart shares have plummeted. Upstart. Offshore shares have plummeted by an almost unfathomable 95% in 13 months. The glaring issue for offshore is the Federal Reserve's hawkish monetary policy shift. With the Federal Reserve has been raising interest rates too much, and its impact on offshore holding is huge. With the Fed having no choice but to gradually raise interest rates to bring down the prevailing inflation rate, loan demand has fallen off a cliff. To add fuel to the fire, loan delinquencies and charge-offs are at high risk of climbing when the U.S. economy weakens. Yet even with these headwinds, offshore's innovation has industry disrupting potential. For decades, loans have been vetted using such metrics like credit scores. Offshore is expounding on this process by leaning on artificial intelligence and machine learning. So, in the past, loan requirement was a bit complicated, and people had to look through documents to see what level this particular person is in. But now by using AI um, and artificial intelligence and machine learning program, this can be done in a second, and it's more precise. And the more people can borrow more money by using this system. So it will take less hours, and the money will go to more people, and people who borrow money will have much more trust because it's not just evaluated by a specific person. It's evaluated by the system, which is made by a lot of programmers uh, who's been thinking it like over and over and over. It's not just made in a day. It's made um, within like long period of time, and it's been made by artificial intelligence. So it's mm, it's more perfect, right? The company's automated software is grower smarter and more efficient at processing and approving loans over time. During the third quarter, 75% of all loans it processed were initially automated. So loans, 75% of all loans were entirely automated. So they made it automated. That's the most important thing here. The help saves its 83 bank and credit union partners time and money. 83 bank and credit unions partners time and money. Okay. Additionally, Upstart's loan vetting process is helping to break down financial barriers for prospective borrowers. So there's been financial barriers for prospect borrowers, but then now they broke it down. So, mm. Despite Upstart approvals having lower average credit scores than a traditional vetting process, the loan delinquency rates between Upstart's AI-driven platform and the traditional approaches have been similar. Okay. There's also plenty of room for expansion. Through 2020, let's look at price level of Upstart holdings and mm, hmm. Despite Upstart approvals having lower average credit scores in the traditional vetting process, the loan delinquency rates between Upstart's AI-driven platform and the traditional process have been similar. The loan delinquency rates between Upstart's AI-driven platform and the traditional process have been similar. There's also plenty of room for expansion. Through 2021, Upstart predominantly focused on personal loans, a 146 billion loan origination market. But beginning this year, it's broadened its horizons to include auto loan originations and small business loans. So in the past, they were focused on a specific area, but now they expanded and they have more businesses. Okay. Auto and small business loans combine for nearly 10 times the origination potential of personal loans. So auto and small businesses is 10 times, okay, the origination of potential of personal loans. Okay. Or it could be a bumpy couple of months until interest rates and bond yields peak. Upstart has the technology in place to double your money by middle decade. Okay. Two growth stocks billionaires can't stop buying the bear market. What are they? Zscaler and Elastic. Zscaler. Elastic. Okay, Elastic. Zscaler is a leader in network security. Its platform, known as Security Service Edge, inspects network traffic and enforces zero trust policies in the cloud, eliminating need for a costly on-premise appliance. Israel Englander of Millennium Management nearly tripled his stake in Zscaler in the third quarter. The looming possibility of recession sent the S&P 500 and Nasdaq Composite spiraling into a bear market this year. Still, some billionaire fund managers bought stocks throughout this downturn. Hmm. Some billionaire fund managers bought stocks throughout the downturn. That's a huge, that's meaningful signal, right? That's a meaningful signal. Okay. For instance, Israel Englander Millennium Management nearly tripled his stake in Zscaler in the third quarter, and his position has increased more than tenfold since the beginning of the year. Similarly, Steve Cohen of Point72 Asset Management nearly tripled position in Elastic since the first quarter. I'll have to look at hmm, what fund managers buy. Uh, there's gotta be like a website or somewhere that I can look into. Anyway, let's read this carefully. Zscaler is a leader in network security. So you don't need to have on-premise appliances as long as you use their service. Mm. It's they what they provide is a network traffic, enforces zero trust policies in the cloud. Mm. In doing so, Zscaler helps users safely access the web, cloud services, and private applications from any device or location. Its portfolio also includes solutions for cloud workload protection, digital experience monitoring. Cloud workload protection, digital experience monitoring. Digital experience monitoring, okay. Zscaler distinguishes itself as the largest network security cloud. It handles 250 billion requests and captures 300 trillion security signals daily. And every data point makes its artificial intelligence engine better at safeguarding sensitive data and applications. The advantage enables Zscaler to deliver better threat protection than other vendors, according to CEO Jay Chandri. So they are like the leader in network security since they receive and request the most signals. Its AI can work better. Hmm. Cybersecurity. Data transformation is a powerful tailwind for many cybersecurity vendors. But Zscaler is growing especially quickly. Revenue rose 61%. Meanwhile, remaining performance obligation, a leading indicator of future revenue, jumped 68%. On that note, investors have several reasons to be optimistic. A research firm Gartner recently ranked Zscaler as leading among SSE vendors, and the company held a leadership position for the past 11 years. Leadership position for the past 11 years. That puts Zscaler in an ideal spot. Gartner estimates 80% of enterprises will adopt SSE platform by 2025. Up from a 20% in 2021, meanwhile, management values its addressable market at $72 billion. Currently, shares trade at 13.9 times sales, a discount to the 3-year average of 37.1 times sales. That creates an attractive opportunity for long-term investors. Okay. Next one we have is a data analytics, Elastic. Elastic specializes in data analytics. Its platform allows businesses to ingest, store, and analyze IT data. And it leans on artificial intelligence to detect anomalies, identify issues, and streamline root cause analysis. The Elastic Stack powers three product suites: enterprise search, observability, and security. Enterprise search is a workplace search engine allowing users to locate in documents and data across corporate systems. It also brings search functionality to website and mobile apps. Observability is a performance monitoring solution that keeps applications, networks, and infrastructure running smoothly. And security is a suite of tools that help organizations prevent, detect, and respond to cybersecurity attacks. According to DB Engines, Elastic is the most popular workplace search engine, topping second place Splunk by a wide margin. Okay. The advantage allowed the company to execute a reasonably successful land and expand growth strategy. The first quarter of fiscal 2023, Elastic increased customer base by 21% to 19,300. It also reported a next expansion rate of just under 130%, meaning the average customer spent almost 30% more over the past year. Last, let's look at Elastic next. Elastic. Hmm. Okay, Elastic. They said the company faces tough competition from cybersecurity software specialists like CrowdStrike and observability software specialists like Datadog. They share in those markets, but I would hold off on buying this stock until there is more evidence the company can generate and grow cash flow consistently. So they have a tough competition. CrowdStrike, Datadog, they are all like competitors in this case. Okay. Next, where will Nvidia stock be in 1 year? Nvidia's growth decelerated significantly over the past year. Its business model stabilized in 2023 as it latched that slowdown. Its valuation doesn't fully reflect those near-term challenges yet. Nvidia didn't provide any guidance for fiscal 2024. However, it believes the stabilization of the gaming, data center, and automotive markets will enable its revenue to grow sequentially over the next few quarters. Crash expects Nvidia's gaming business to improve as it works through the channel inventory corrections caused by the post-pandemic slowdown in video games and exacerbated by the decline of the crypto market. Mm. Mhm. Okay. Mhm. Let's look at only a few articles from marketbeat.com and let's finish it today, okay? Mm. Okay, this is it for today. I want to finish it today. So I'll see you guys tomorrow, okay? Bye bye.